Hummingbot is an open source software platform that helps you build market making and arbitrage bots that can run on any cryptocurrency exchange. This video is the first in a series on the cross-exchange market making strategy that can be employed when using the Hummingbot market making software. The aim of the series is to teach you how the cross-exchange market making strategy can be employed, plus provide you with some insights as to how this style of strategy is utilized by professional traders. In this video series, we will cover what cross-exchange market making is and how it can be employed as a form of algorithmic trading, how to configure a cross-exchange market-making strategy using Hummingbot, and we'll go through a number of examples so you can see how the strategy works in real time. The focus of our first video will be on the key concepts behind cross-exchange market making. Having a solid understanding of the concepts behind the strategy will allow you to understand the results you achieve when running the bot in real time. It will also allow you to modify your strategies to help you maximize your profits. Before we start, I need to make the disclaimer that this video is intended for educational purposes only. Investing and trading in cryptocurrencies is inherently speculative, and you should do your own research before making any investment decisions. Before we get into the details of today's video, I need to highlight that if you are watching this, then I am assuming that you already know a little bit about Hummingbot, and that you have watched a recent video by Mike, Hummingbot's CEO, about key concepts in professional market making. If that's not the case, I've included some video links in the description below to help you get started. Assuming you're up to speed on these topics, let's dive into today's content. Cross-exchange market making is seen as a good strategy for new entrants to the market making landscape. Why? Because it allows you to hedge risk. If we refer back to one of the slides from Mike's previous video, we can see that one of the keys to professional market making is understanding how to treat market risk. Market risk is the risk of accumulating the asset that is decreasing in value for any given trading pair. This is a very common problem faced by many market makers, and in the absence of mitigating strategies, this will occur whenever the market trends. Cross-exchange market making is one way to mitigate this risk. How does it do this? To understand how it does this, we first need to understand how the cross-exchange market making strategy itself works. To demonstrate this, we will start by reviewing a different strategy known as arbitrage. Arbitrage is a classic market making strategy and is what many people think of when they think of algorithmic trading. The cross-exchange market making strategy is a modification of classical arbitrage. So understanding arbitrage will help us to understand cross-exchange market making itself. Imagine a scenario where we are seeking to trade a hypothetical token, which I've called ABC token. In our example, we can see that ABC is listed on two separate exchanges, KuCoin and Binance. What we see when we look at the exchange data for this hypothetical situation is that KuCoin has a larger buy-sell spread than Binance. You can see in our scenario that on Binance the best bid order is 99 cents, whereas on KuCoin the best bid order is at 98. Similarly, on Binance the best ask order is at $1.01, whereas on KuCoin it is at $1.02. Generally speaking, a tighter spread indicates a more liquid market, as tighter spreads are indicative of a higher trading activity and more competitive price action. So in our hypothetical scenario, KuCoin is the less liquid market and Binance is the more liquid market. A classical arbitrage strategy would seek to take advantage of this pricing mismatch by selling one token of ABC at $1.02 on KuCoin whilst concurrently buying it back for $1.01 on Binance. By doing this, we would have executed two trades, with our total inventory position remaining the same whilst capturing the spread of 1 cent on the way through. The profit from this scenario can be calculated as follows, which shows that if I sell a token at $1.02 and then buy it back at $1.01, then my total profit is approximately 1% for every trade I execute. We could also execute the inverse of this trade by buying on the less liquid exchange at 98 cents and selling on the more liquid exchange at 99, once again capturing a profit of approximately 1% on the way through. I need to highlight that in my example, I've artificially widened the spreads in order to demonstrate the underlying concepts. It's extremely unlikely that you would find an arbitrage opportunity as obvious as this in the real world. For educational purposes though, it serves to demonstrate the concepts that we are trying to understand. What you will notice when we look at this example is that our total inventory of ABC is not changing. In our first example, where we sold at a higher price and then bought back on the more liquid exchange, we are buying one token for every token that we sell. Thus, our total inventory position remains unchanged. Because of this, we have effectively mitigated market risk because our inventory position is stable and constant. In a classical arbitrage strategy, we do not place any orders in the market until we see a pricing discrepancy develop. We tell our bot what profit margin we need to achieve for a trade to occur, and the bot will then continuously monitor the markets in which we wish to trade. Once a suitable profit opportunity is identified, the bot immediately places offsetting buy and sell orders to capture that profit. Cross-exchange market making is an extension on traditional arbitrage. The same principles apply, except that in this case we want to have orders sitting on the order book so that we can earn liquidity mining rewards, as these are one of our primary sources of profit as a market maker. When setting up a cross-exchange market making strategy, we once again instruct the bot what profit we need to make in order for a trade to be executed. The bot then calculates the required spread for our market making orders. such that it can immediately offset any trade should your market making order be filled. Let's look at an example of this, once again using our hypothetical ABC token. This time I've modified our example to use some more realistic spreads. In this example, we will be seeking a profit per trade of 0.5%. We can see that the best available ask order on the taker exchange is $1.001, or 100.1 cents to say it slightly differently. Based on the required profit of 0.05% that we have specified, our market making bot will place an order on the maker exchange at 100.5 cents. Similarly, based on our required profit of 0.5%, our bot also places a bid order at 99.3 cents on the maker exchange. What this means in real terms is that if our maker bid order is filled at 99.3 cents and we acquire one ABC token, we can immediately place an offsetting taker order to sell that token on the more liquid exchange at 99.9 cents. If we successfully execute both of these trades, then we will have captured a net profit of 0.5% on the way through whilst maintaining a constant inventory position. What we are effectively doing when we execute a cross-exchange market making strategy in this scenario is that we are effectively moving liquidity from the deeper, more liquid exchange over to the less liquid exchange. One way to think of this is to use the analogy of Robin Hood. Robin Hood would rob from the rich to give to the poor. If we think of liquidity as an asset, a market maker employing a cross-exchange market making strategy is effectively taking liquidity from the richer, more liquid exchange and moving it to the poorer, less liquid exchange. It is because liquidity is valuable to exchange providers that they will provide liquidity mining incentives to encourage traders like you to move liquidity from a more liquid exchange to their less liquid exchange. If we refer back to the keys to professional market making, we can now see how cross-exchange market making performs against our 4 key criteria. The first is market risk, which we have covered in depth, and it should be clear how a cross-exchange market making strategy helps to mitigate this risk. It should be noted, however, that there is no such thing as a free lunch, especially in crypto, and that while market risk is reduced, we have also introduced a new risk in the form of execution risk. Execution risk is the risk that we may not be able to execute our taker orders at a price that is favorable. This is a situation where a maker order is filled, but the bot is unable to execute a taker order at the price that you need to meet your required profit margin. This will usually be because the market price has moved between when the maker order was filled and when the taker order is placed. There are some additional configuration settings in the strategy that you can use to specify what the bot will do under this scenario, but it is not uncommon for the taker order to be placed at a price that is less than optimal. This has the overall effect of reducing the profitability of your strategy. We will talk more about this in our next video when we look at the results of a real-world trading demonstration. Our next consideration is liquidity rewards. The Hummingbot cross-exchange market making strategy allows us to earn liquidity mining rewards by maintaining orders on the order book of our maker exchange. These rewards can be used to offset our transaction costs and in many cases may be the main source of profit from our trading activity. One of the most popular places for finding these kinds of incentives is Hummingbot's own miner platform. It's worth considering this point in a little more depth. As highlighted in our previous video on keys to professional market making, Hummingbot has attracted an increasing number of professional traders over the last 12 months. One of the key learnings from working with these professional traders is that many view liquidity mining rewards and other similar incentives as the primary driver of their profits. Whilst traditionally, algorithmic traders have sought trading profits as their source of income, this is often not the case in cryptocurrency markets. Many professional traders seek to break even on their trading activities and earn income from the numerous rewards that are offered by the various exchanges. This can have a significant impact on the way we design our strategies, as we can see in our next video. In terms of transaction costs, it should be apparent that we have effectively doubled our transaction costs because we are now executing 2 orders instead of 1 every time our market making order is filled. It's important that you account for this in your calculations when determining your required profit margin. Because we are generally seeking to make profits of fractions of 1% on each trade, transaction costs can significantly impact the profitability of our strategy. There are also other costs incurred by a cross-exchange market making strategy. Most obvious is the cost of moving funds between exchanges. Because you are trading on 2 exchanges concurrently, if the market trends, it's possible that you will accumulate all of your inventory on one exchange. The simplest solution to this is to transfer funds between exchanges to rebalance your inventory position. This is not without costs, however, and the cost can be significant in some circumstances. A real-world example of this can be seen by looking at the price chart of the Ethereum USDT pair on both Loopring and Binance. As you can see, there is a reasonably significant difference between the price of Ethereum on Loopring compared to Binance. At first glance, this may seem like an opportunity for an arbitrage-based trading strategy. What needs to be taken into account, however, is that moving assets between Binance and Loopring is extremely expensive. There is a transaction cost incurred when using the ERC20 network to move assets between the 2 exchanges, and then there is also an additional transaction cost occurred when depositing or withdrawing funds from the Loopring Layer 2 exchange. So what might seem to be an attractive opportunity soon becomes unattractive once transaction costs are factored in. The final point to consider is trust and safety. Trust and safety refers to how much we trust the various exchanges upon which we choose to engage in market-making activity. Exchange-related risk is doubled in cross-exchange market-making because we are choosing to place orders and thus hold inventory on two separate exchanges rather than just one. Less liquid exchanges are often also smaller and less established. Therefore, appropriate due diligence is required to ensure they are trustworthy. It's important that you take these factors into account when considering whether or not to pursue a cross-exchange market-making strategy in any given scenario. That brings us to the end of our first video. Hopefully, by now you have a good understanding of how cross-exchange market making works and how you can employ the strategy to seek profit in cryptocurrency markets. In our next video, we'll go through a number of demonstrations, including how to configure the strategy in Hummingbot, and we'll look at the results achieved when running the strategy in a number of real-life situations. If you like what you see in this video, please remember to hit those like and subscribe buttons to stay up to date with the latest content from Hummingbot.